Welcome to Iron Financial. Here, our mission is simple. We help you forge a stronger portfolio. How do we do that? By cutting right through all the market weakness and hammering away on the hard data. We just don't do hype here. We deal in fundamentals, period. And today, we are putting a really fascinating and, let's be honest, a super polarizing company under the microscope. We're talking about Belite Bio, that's ticker BLTE. Now, this is a clinical stage biotech that has the market in an absolute tug-of-war. So, let's get to it. It's time to fire up the forge and hammer out what's really going on with Belite Bio.
So let's just cut right to the chase. This is the question, isn't it? This is the one that gets right to the heart of the matter. It's the paradox that completely defines this stock. Belite Bio, they reported exactly $0 in revenue last quarter. I want that to sink in. Not a single penny came in the door. And yet somehow, the market has slapped a valuation on this company that is north of $6.5 billion. I mean, in almost any other industry, this would be completely laughable. It just defies all conventional logic. But here's the thing. In biotech, sometimes the most illogical-looking structures are the ones that end up reaching for the sky. So the question you really have to ask yourself is this. Are we looking at a visionary bet on the future, or are we just witnessing a spectacular, epic failure of market risk management? Let's dig in and find out.
And this is exactly why we're talking about it today. This isn't some sleepy stock that's been trading sideways for years. I want you to look at this slide. That number represents the one-year total shareholder return. We're talking about nearly 5 times your money in just 12 months. A 5x return is the kind of explosive move that builds legends on Wall Street. And, frankly, it attracts a swarm of capital. It creates this gravitational pull that's just almost impossible for investors to ignore. But let me be very clear. Massive, rapid gains like this, especially when they're completely disconnected from current earnings, should also be seen as a massive, flashing warning flare. When a stock's price decouples from its financial reality this dramatically, we don't just sit back and watch. No. We take out our hammers, and we stress test the entire structure until we find every single crack.
Okay, that's enough with the hype and the stock chart. It's time to do what we do best here at Iron Financial. Drill down deep into the hard numbers. We need to see if the foundation of this company can actually support the skyscraper valuation the market has decided to build on top of it. We're looking for strength, for sure, but more importantly right now, we're looking for weakness. We're looking for cracks, so let's get to work.
And here we go. Here is the first major crack. And believe me, it is a big one. This number, this represents the company's full-year net loss for 2025. They lost nearly $78 million. This isn't a projection. This is a fact. And just to be clear, this isn't profit. It's the cold, hard cash they burned through in a single year just to keep the lights on and the labs running. Now look, a loss is expected for a clinical stage biotech company, right? That's kind of baked into the business model. But it's the sheer size of this loss that puts the first serious dent in its financial armor. This is a significant, sustained cash outflow that immediately puts a ticking clock on the company's very survival.
So here's where it gets really interesting. It's not just that they're losing money. The real problem, when you look at these numbers, is how fast that loss is accelerating. I mean, the cash burn is getting worse, and it's getting worse fast. Take a look. R&D costs, they jumped from just under $30 million to over $45 million in 1 year. Okay, you could argue that makes some sense, right? They're pushing their big drug through some pretty expensive late-stage trials. But the real alarm bell for me, the one that's ringing off the hook, it's that selling, general, and admin line. It didn't just go up, it nearly quadrupled. It exploded from $10 million to almost $39 million. Now, what does that tell you? It tells me they are building out a massive corporate machine to sell a drug they don't even have approval for yet. I mean, that is an incredibly bold, super aggressive move. They're basically pouring gasoline on a fire that's already burning through cash like crazy.
So, with all that risk, how is the market pricing this company? Well, this bar chart just shows the staggering disconnect from reality. We're looking at the price-to-book ratio here. It's a simple metric. Basically, it's how much you're paying for the company's net assets on the books. As you can see, Belite Bio is trading at 26 times its book value. Now, look at the industry average right next to it, 2.2 times. Let me spell that out. This isn't just a small premium, it is a colossal one. It means that you, the investor, are paying more than 10 times the standard price for every single dollar of this company's physical assets. From a fundamental perspective, this structure is under some serious extreme tension. It's priced for absolute perfection, with zero, and I mean zero margin for error.
Whoa, hold on a minute. You're painting a really grim picture here. I mean, all I'm hearing is cracks in the foundation, accelerating cash burn, a valuation that's completely insane. It sounds like you're describing a total trap, but something doesn't add up. If it's so bad,
How do you explain that 5x return we just saw? How do you explain a multi-billion-dollar market cap? Are these numbers, these fundamentals, are they really telling us the whole story here? I gotta think the market is seeing something big, that a simple balance sheet review just isn't catching. There has to be another side to this. There just has to be.
Exactly. That's the perfect question. So let's try to forge a real bull case here. If the fundamentals are really that poor, then why are some of the smartest, most sophisticated investors in the world piling into this thing? Why is Wall Street building this gleaming, shiny skyscraper on what you just described as a cracked foundation? Well, it's because they aren't looking at the foundation as it exists today. Not at all. They're looking at the blueprints. They're not buying the company for what it is. They're buying it for what it could become. In the world of biotech, you're never paying for the assets in the building. You're paying for the potential cure that's being developed inside it.
And this right here, this is the blueprint that the market is so excited about. It all comes down to one single drug, Tinlarebant. And what is it? It's an oral, once-a-day pill for treating degenerative retinal diseases, specifically something called Stargardt's disease, which is a leading cause of juvenile blindness and, get this, currently has no FDA-approved treatment. Zero. And this isn't some pie-in-the-sky idea. They've already reported positive top-line results from their global Phase 3 Dragon trial. For anyone who doesn't follow biotech, that is a huge, massive milestone. It means the initial data hit its primary goals. Because of that, they're on track to submit their new drug application to the FDA in the second quarter of 2026. This isn't some 10-year dream. This is a very real near-term catalyst for what could be a blockbuster drug.
And if you're sitting there thinking this is just retail traders getting caught up in the hype, I want you to look very closely at this slide. This is a list of who was buying this stock in just the last quarter of 2025. These are not small-time players. Darwin Global added over 3 million shares. Their position is now worth nearly $500 million. RTW, Millennium, Steve Cohen's .72. I mean, these are some of the sharpest, most well-resourced hedge funds on the entire planet. 53 different institutions added to their positions, while only 14 trimmed back. This is what we mean when we say follow the smart money. You have to believe they have teams of PhDs analyzing every piece of this clinical data, and they are making massive 9-figure bets that Tinlarebant gets approved. They're doing the heavy lifting, and their 9-figure checks are shouting a very, very bullish conclusion.
And it's not just the hedge funds buying up shares. The sell-side analysts, the folks who cover the stock for Wall Street, they are firmly behind this story too. Just this January, Morgan Stanley, come on, one of the most influential banks in the world, they started covering the stock with an overweight rating. That's just Wall Street analysts speak for, we believe this stock is going to outperform its peers. And they're not alone. They're joined by big firms like Mizuho and Cantor Fitzgerald, all of them with buy-equivalent ratings. When you see this kind of institutional and analyst alignment all pointing in the same direction, it creates this incredibly powerful narrative that tells you the bull case has some serious credibility on the street.
Okay, you've made your point. A promising pipeline and some very big money bets. That is a powerful counter-argument, I'll give you that. But it doesn't just erase the gallons of red ink on the balance sheet. It just creates a conflict. And this brings us to the absolute core battleground for this stock, the great valuation tug-of-war. You have two completely valid, yet diametrically opposed ways of looking at this company, and they are pulling its stock price in opposite directions every single day.
And this slide right here brilliantly illustrates that conflict. On the left side, you've got the foundation. This is the price-to-book view we talked about earlier. It looks at the tangible assets on the books right now, and it concludes that at a 26x multiple, this stock is wildly, dangerously overvalued. It's a bet on current reality. But then on the right, you have the blueprint. This is a discounted cash flow or a DCF model, and it completely ignores today's financials. It just throws them out the window. Instead, the analysts project the billions and billions in potential future cash flows from Tinlarebant, assuming it gets approved and captures the market. Then they discount all those future billions back to what they're worth today. And on that basis, some of these models estimate the stock is actually 75% undervalued. So which one is it? Is the structure dangerously overpriced, or is the blueprint an absolute bargain? Your answer to that question defines your entire investment thesis.
So let's do it. Let's bring these two opposing sides together and try to forge a final verdict. We've seen the very real cracks in the foundation, the massive losses, the accelerating cash burn, that extreme price-to-book multiple. And we've seen the incredible strength of the blueprint, the promising Phase 3 data, that near-term FDA catalyst, and of course, the massive institutional buying. To make any sense of this, we need to be using the right framework.
This right here, this is the absolute key to understanding this company. You cannot analyze Belite Bio like you would analyze a General Electric or a Coca-Cola. It is what we call a binary event stock. Its entire fate, its entire multi-billion-dollar valuation hinges on one single future event, the FDA's decision on tinlarebant. It's really common in the biotech world. Drug development is so incredibly expensive and has such a low success rate that companies will often pour every single resource they have into one promising candidate. If that drug gets approved, the valuation goes to the moon. If it gets rejected, the entire house of cards just collapses overnight because there is no plan B. Every other metric we've discussed is just noise compared to that single binary outcome.
So if we know that, the only question that really matters between now and that FDA decision is survival. It's that simple. Can they afford to keep the lights on and fund all their operations until that binary event finally happens? This slide shows you the answer. As of the end of 2025, Belite Bio had over $352 million in cash and cash equivalents sitting in the bank. After their recent public offering, they've successfully built a war chest. And this isn't just cash on a balance sheet, it's a lifeline. It is the runway they need to survive that $77 million a year cash burn while they wait for the FDA's verdict. This cash position is the steel reinforcement that allows this whole structure to withstand the immense financial pressure until the big day finally arrives.
So here it is, the final summary, laid out as clearly as we can possibly make it. The structural risks are truly immense. You have the catastrophic possibility of a total FDA rejection. You could get more negative trial data along the way. You have that sustained, punishing cash burn. And of course, the extreme share price volatility you're going to have to live with. But the potential rewards on the other side of the ledger are equally massive. We're talking about first-mover market exclusivity for a potential blockbuster drug targeting a condition with a huge unmet medical need and, as we've already seen, the potential for an absolutely enormous shareholder return.
And so, we end right back where we began. What exactly is Belite Bio? Is it a financial fortress built with a massive cash buffer and a detailed blueprint for a blockbuster drug just waiting to be fully realized? Or is it just an impossibly valued house of cards, propped up by nothing more than hype and hope, waiting for a single gust of wind from an FDA rejection letter to blow the whole thing down? The data, as we've shown you, presents both cases with compelling force. The final verdict? Well, that rests on which story, the foundation or the blueprint you choose to believe. And that is a decision every investor has to forge for themselves.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.